Hi, and welcome to FxPro's Educational Video Series. If you've ever looked at a trading chart and thought, what on earth is going on here? You're not alone. I've been there too. When I first started trading, the screen was a blur of candles, prices jumping all over the place, and no clear direction. It felt impossible to make sense of it. Where's the market going? When should I get in? When should I get out? That's when I realized I needed a guide, a tool to help cut through the noise and reveal the underlying trend, something simple but powerful. And that's exactly what I found in one of the most popular technical indicators out there, the moving average. A moving average is a line that shows the average price over a chosen period. It smooths out the active multi-directional movements of quotes on the chart and helps you see the overall direction of the price, up or down. It's like turning off a stormy sea and being left with a calm, clear direction. Simple, but powerful. Time for a little maths. I promise it'll be quick. Here's how a moving average is calculated. Imagine we have the last 5 prices for a currency pair. 100, 101, 102, 99, and 98. Add them all up, divide by 5, and you get 100. That becomes your current point on the moving average. Then, the window moves forward. The first price drops out, a new one comes in, and we calculate again. That's why it's called moving. The line updates constantly. And now time for the formula, but just for a moment so we don't scare off the maths shy. Phew, let's move on. If you open the moving average settings, you will see that there are several of them: SMA, EMA, and WMA. What does all this mean, and how do you choose the right one? SMA is the simple moving average. It's calculated just like we showed. All price is added and divided by the number of periods. This line is nice and smooth, but a bit slow to react since every price has the same weight. EMA stands for exponential moving average. It's similar, but gives more importance to the most recent prices. That makes it quicker to respond to price changes. WMA, weighted moving average, is the most sensitive of the bunch. Each price gets a specific weight. The newer the price, the more important it is. It's a bit tricky to configure, so we'll skip it for now. To sum up, if you want something stable, go for SMA. If you want something quicker, use EMA. If you want something sophisticated, use WMA. So, what are these numbers and periods? The period means how many candles are used to calculate the moving average. Shorter periods equals faster reaction, but more noise. Longer periods equals smoother lines, but slower to react. For example, a 10 or 20 period MA moves quickly, but can give false signals. It tends to jitter. Prefer something calmer? Use 100 or 200. They're slower, but great for long-term trends and investing. To start with, try a 50-period average, then add a 200-period MA. These two are favorites among traders. Now look, they're crossing. What does that mean? Now you see the trend. Ignore the trend, and you might end up ignoring your profits. Why do traders and investors love moving averages? Because they work. Just add a 50-period moving average to a daily chart, and you'll instantly get a feel for who's in charge, the bulls or the bears. Let's take a look. If the price is above the line, the trend is up. If it's below, the trend is down. Crystal clear. Let's go even further. Now let's add a 200-period moving average. And here's your first basic strategy: magic. Now let's focus on the indicators. When the faster MA50 crosses the slower MA200 from below, that's a potential buy signal. From above, that's often a sell signal. But remember, it's never guaranteed. No magic here, just maths doing the heavy lifting. Can we improve this? Of course, add another indicator that shows the market from a different angle. That'll give you better signals. RSI, stochastic, or other oscillators can show market momentum. If it's in the oversold zone, it's often too late to buy. And vice versa. OBV, or volume indicators, show how strong the trend is. More money in the market equals more power behind the move. You get the idea. Explore, experiment, think it through. Moving averages are a treasure chest if you use them wisely. So, if you're so smart, why are you broke? Good question. Even the best tools have their flaws. Moving averages are lagging indicators. They show you what's already happened, not what's coming next. So when there's a strong trend, they work well. But in sideways markets, they can whipsaw, up, down, giving false signals. Traders call this a saw, and yes, it can slice through your balance. That's why it's risky to use just one moving average. Combine it with other tools for better results. So, the moving average is like a compass in trading. It doesn't tell you exactly where to go, but it points you in the right direction. Master it, and reading charts gets way easier. And yes, you can try all of this risk-free on a demo account right now. The registration link is in the description below. While you're at it, hit subscribe so you don't miss our next episode. Simple videos for complex markets.